Okay, so we start this financial performance measurement. This is continuation from the previous chapter. We did chapter 15. Now this is chapter number 16 in your BPP books. Financial performance. We said that there is a performance measurement. And when you say only performance measurement, it could be financial, it could be non-financial. And we discussed that when you do those variances and budgets, that is financial performance. Like ratio analysis we do, variance analysis we do, that is part of financial performance. But you do have non-financial performance as well, which is like, customer satisfaction, and you call it your image of the company, customer loyalty, brand value. All these are called non-financial performance. Now, before I move forward, let me tell you that okay, in general, I will tell you that what is how the financial and non-financial performance it works. You should remember that your financial performance, which is your ratio analysis, like your profitability ratios, your liquidity ratio, how much profit you have made, and then your variance analysis. This is called financial performance. It only tells you about how did you do in the last year. It tells you about your past and current performance. It does not speak anything about future. Okay, so I'm repeating again, financial performance measurement, it is an internal view of the business, and it tells only about our past and our current situation. It does not give a very clear message about future. This is one of the drawbacks of financial performance measurement. For example, if I say that a business made $1 million last year, it does not mean that it will make $1 million next year also. I mean, there is no assurity. Whereas the non-financial performance measurement, non-financial performance, it gives you more indication of about future. So you should remember that non-financial, it tells you more about your future performance, about your future. For example, if I tell you that a business made $1 million in last year, that's a nice profit. Okay, you are happy. But then if I tell you that customer satisfaction is going down or product reliability is going down, so what do you imagine? You imagine that next year the profits will go down, because you probably have made good money last year, but because your customer satisfaction is going down or product reliability is going down, next year maybe your profits will be less. So I'm summing it up: financial performance, non-financial performance. Financial performance is about numbers. It tells you more about your past and your current situation, and very little about future. Whereas the non-financial performance, which is not in numbers, which are other factors, they speak more about the future of the business. Anyways, in this chapter, we talk about financial performance measurement. And we do need to measure the performance of the business to understand how good or how bad are we doing. So performance measures, we speak like performance measures can be divided into two groups. It is called financial performance measures and non-financial performance measures. And actually, we will discuss this subject in more detail in your F5, because F5 is called PM performance management. And there are two things actually you should remember. One is called measurement, one is called management. So performance measurement, in which you are measuring the performance. And the next step is performance management, in which you are managing the performance. So your F5 syllabus, the paper ACC F5, the name itself is called PM performance management, which is next step to performance measurement. So financial performance measures profit, revenue, cost, share prices, and cash flow. These all are, related to numbers. And non-financial performance measures include product quality, reliability, customer satisfaction, etc. Performance measures can be quantitative or qualitative. So deciding what measures to use. How do you measure your performance? So there are different aspects, For example, measures needs resources. Now, of course, measurement needs resources. What does that mean? If you want to measure performance, you need to allocate some people, you need to allocate some resources who are collecting the data, who are analyzing the data, and who are doing the interpretation of data. So definitely, if you want to measure your performance, you need to incur some cost on that. There are some costs which are associated, it will not be done automatically. So when you are incurring cost on that, so then you have to think that which things you should measure. I mean, there is a word we use in management accounting which is called cost benefit analysis. Like, you see the benefit, and then you see that should I spend this cost or not? Because let's suppose you are measuring some performance, but the cost of measuring that performance is more than the benefit. So then you just do not do it. I mean, cost of doing something is more than the benefit which you may get, then you just do not do that action. So you need to see that which areas are critical, which areas are important for you, and you measure cost for that. I give you one very simple example from, how to say, real life, a little bit old style of working. It was before, not now. In big companies, it is just ignored. For example, let me tell you, imagine that you work in a company, and in your company there is a printer which is in a common place, and there are 50, 60, or 100 people, they work and they give printouts. And you feel that some people are taking personal printouts, or you feel that some people are, wasting, they are doing extra printing, and they are probably, misusing the office papers and toner. So you think that you need to control it. How do you control that? You decide that I will bring in one person, one resource, who will, take control of this printing and photocopy process. So everybody should not be using the photocopier. Everybody should give this person, and he will make the photocopies, so that you can control this activity. You know what? It's not a very good idea, because papers are so cheap today, and printing cost has come down so much that the person whom you will give something like, I don't know, $400 or $500 salary for hiring a person, a very local, very low base, a very minimum base salary I'm giving him. So the cost of his salary is much more than the wastage of paper. Let the paper be wasted, because if everybody is doing some waste, probably that waste is just $100, but the money which you are going to give to this person probably is more. So the benefit is you save 100, but the cost is 400. So you spend $400 to save $100. Does not make sense. So this is what we say, that which measures to use. You do cost benefit analysis. So measurement, they needs resources. This means people, equipment, and time to collect and analyze information. And there is cost benefit analysis which you must do. Performance must be measured in relation to something. Definitely you measure against, like when you say that you have to measure weight, your reference point is kilogram. You measure distance, your reference point is meter or kilometers. So whenever you have to measure, you measure it against something. Just like we talked about our standard cost, let's like we talked about our budgeting. So that is, you set your standards, and then you measure against those standards, that if you are meeting or achieving those standards or not. Measures must be relevant. This means finding out what the organization does and how it does it, so that its measures reflect what actually occurs. So whatever measures you choose, they should be related, relevant, and important to your nature of business. So you are not measuring something which is not your, how to say, core activity, or you are not measuring something which is not relevant to you or to your customers. I mean, we need to see, by the way, you should remember that every action or every activity which is performed in a business has a cost. When you enter to your office, you turn on the light, it has a cost. You turn on your air conditioner, it has a cost. You turn on your computer, it has a cost. You give a print command, you just say print it, it has a cost. And in business, we only spend money which should be adding value to the process, or should be adding value to the customer. because we are making some product or some service. So anything or any dollar which you spend in business should be adding value to the process or to the ultimate product or service. Because if it is not adding value, the customer is not willing to pay. You should remember one thing, that all the money which you spend in business should ultimately be collected from customers. Businesses do not pay from their pocket. You know, when you see this company Coca-Cola, they give a lot of advertisement. Who pays for that advertisement? Customers pay for advertisement because they charge this cost of advertisement into their selling price. If you see that some companies giving some very expensive cars to their employees, who is going to pay for those benefits and perks? Customers will have to pay. Nobody is paying from their pocket. So whatever money you spend, ultimately you add it into the selling price and recover it from the customer. So if you are spending some extra money which is not needed, which is not relevant to your business, so and then you start charging it to your customer, they become unhappy and they become unwilling to do business with you. So you must be seeing that what are the relevant costs in the business, the costs which are going to add value, the costs which are going to add value to the final product and the final process, and then you move forward. Measurement needs responses. So managers will only respond to measures that they find useful. The management accountant therefore needs to adopt a modern marketing philosophy to the provision of performance measures, satisfy customer wants rather than aiming to sell large quantities of a product at a cheap price. So whatever you measure, or whatever is the purpose of measurement, it needs responses. Response means that there should be some feedback to that, there should be some reaction to that. After you have done measurement, somebody should be held responsible and people should be responding, and they do respond only those things which they are useful for them. Financial performance measures. So there are different dimensions. How do you measure your financial performance? First, and the very simple is profit. You calculate how much profit did we make this year, how much profit did we make last year. So profit is the net earnings which you can take home, the net earnings which you can distribute to your shareholders. Then you have revenue, and revenue is like the total sales volume. There are different words which we use, like you use the word sales, you use the word turnover, you use the word revenue, and sometimes you use the word sales revenue. All of these words, they are same. It means the value of goods or services which you provide. So revenue is not your profit. Revenue is the gross amount. Revenue minus cost becomes your profit. And then you have cost, like all the expenditures which you do. So this is just like examples, okay? When if I read it, like profit is the most common measure of all. Return on investment is also frequently used. ICI increased pre-tax profits to $233 million. It's just an example. So ICI is the name of the company. ICI, it increased their profits to 233 million. So it is just an example. So businesses, usually they measure their profit if they are not making. Because let's suppose that your revenues are increasing, looks very good, but then you see that profits are not increasing, profits are same. So may not be very helpful, because ultimately we are not interested in revenue, we are more interested in profit, because profit is something which belongs to shareholders. So revenue, if you are increasing, for example, in 2008, your revenue was 100 and your cost was 70 and your profit is say 30. So this is your profit, okay? I put it like this. This is your profit. And then in next year, in 2009, you say that, oh, I made more revenue. My revenue is 130, and then your costs are also 100. So profit comes out to be 30 again. So maybe you have sold more goods, but the thing is that it is no benefit for the shareholders. Shareholders were getting the same amount which they were getting before. So shareholders are more interested in the profit thing, because profit is something which they can take home. So if revenue increased, cost also increased, which means there is no net benefit to the business. So we are more interested in profit thing, okay? Share price is one more thing, which is very important for public limited companies, listed companies, quoted companies, which means those companies which are registered on the stock exchange and their shares are sold in the market. So share price increase, it is also one performance measure. Every company wants that the share price should go up, because when share price goes up, investors, they get benefit. Share is just like an asset. I mean, some people have money, they buy land. The other people have money, they buy shares. So if you purchase some piece of land, you want that the land price should go up so that you make some profit out of that. Similarly, those people who buy shares, they want that share price should go up. Nobody wants that share price is going down. If share price is going down, investors are not happy. Just like imagine that you purchase some house and then then prices for houses, they go down. You are not happy because you are losing money. Okay, so share price is also one performance measure. So when you have to measure your financial performance, share price is one measure. And cash flow. Cash flow was also continuing to improve. Cash flow is very important because you know what happens, that profit is something, when you will learn your ACCA F3, you will see that profit is something which is just on paper. Profit is not in your hand. It is quite possible that you have profit 30, but you have got cash 0. It is possible that your profit is 30, but cash is 0. You will learn this in your paper F3, that how or why it happens. So if profit is 30 and cash is 0, what would I give to shareholders? Shareholders, they come in, investor, they come in, they say, how was the performance of the business? I say, we did very good. We made a profit of 30 million or 30,000 or whatever. And they say, okay, give us some dividend, give us some share from the profit. And I say, I'm sorry, I cannot give you because I don't have cash. I will only annoy my shareholders, investors. I mean, you need cash in the business because you have to pay your taxes, your dividends, your liabilities. So the performance of a business is also measured based on cash. How much cash are they generating? How much cash do they have? Because if you do not have cash, what to do with that profit? So there are different measures based on which you measure your performance. Measuring profitability and productivity. So profitability means how much profit you are making, and productivity means that how efficient you are. Efficient you are means that how efficiently you are using your resources. Uh, Profitability can be measured by return on investment. So there are different ratios. One is called return on investment, ROI. So the formula for return on investment is, return on capital employed. Then you have another thing, return on capital employed, ROCE. I'm going to show you these formulas separately. Return on equity. So what is return on equity? Now let me tell you that there are two words in your accounting. One is called equity. Okay, let me write down like this. Any business has capital. I mean, when you start a business, you must invest some capital into your business. And capital, it consists of equity plus debt. So if you start a business and you put $100 into your business, and then maybe equity is 60, debt is 40. It means that out of this $100, $60 was invested by the shareholders, and $40 has been taken from outside. Okay, debt means that maybe you took a loan from the bank. So return on equity means, return on equity, when you say return on equity, means that equity is the money which belongs to the shareholders, debt is the money which belongs to the outsiders. So shareholders have invested $60. How much profit they are making? This is called return on equity. Return on equity means that what profit a business has made on equity, on the money which belongs to the shareholders. You may have return on investment. Return on investment means all of that. All of that. Whatever investment you have, how much profit you are making in relation to investment. And then you may have return on capital employed, which is the same thing. And gross profit margin ratio, net profit margin ratio, cost of sales ratio. So these are different measures which you have to calculate. What percentage of net profit you are making? For example, your sales, let's suppose that your sales are here 100 and your profit is, let's suppose, I don't know, let's call any number. Your profit is say 20. So it means that your net profit ratio, your net profit ratio is 20%, which means that 20% of your revenue becomes your net profit. So it looks good. Next year, so this is 2008, and in next year, in 2009, what happened? Your sales improved by 120,000. So you made a 20% increase in your sales. And then your profit is say 22,000 or 22. So it looks like that sales have increased. Okay, let me call it 130. Okay, this is 130 and this is like, so now although your profit has increased from 20,000 to 22,000, but if you want to calculate its percentage, in terms of percentage, it has gone down. It is 19%. Okay, so we are not doing good, very honestly, because our sales have increased. That is a good sign. Profit has increased in terms of dollars, like $2 you have increased, but in terms of percentage, your profit has gone down. Last year, you were making 20% profit. This year, you are just making 19%. If I consider 20% here, my profit should be 26, okay? It should not be 22. It should not be 22, it should be $26. I mean, if I think that my profit margin is 20%, then from 130, 20% is 26. So you are actually making less profit. You should have been making more. You did make two more, you did make 22, but you should have been making 26. So this is how you calculate your performance. So this is, I just showed you net profit ratio. Typical performance measures. So which areas do we measure? We measure our performance on cost centers, revenue centers, profit centers, and investment centers. And managers, they are responsible for cost. We said that a cost center is any department which is only responsible for cost. And we said IT department, HR department. And how do we do it? With the help of variances. You may have a revenue center like your sales department, and revenue department, their performance is measured based on revenue, how much sales volume, how much turnover they have brought in, and you talk about revenues. You may have profit centers. Profit centers, I told you, if you remember that the branch of a bank is a profit center. The branch of a bank is a profit center. So that profit center performance you should measure based on cost and revenues, because revenues minus cost will give you profit. Okay, revenues minus cost will give you profit. So you should be measuring costs and revenue both for profit center. And for investment center, you need to manage cost, revenues, and assets as well. Assets because they have investment and they make that investment in different assets. So you need to see that how effectively they are managing the assets of the business. How effectively are they investing their money in different assets. So these are different responsibility centers and different areas where they are responsible for. Return on investment, ROI. So how do we do that? Okay, so this is ROI. Now, you know what, these chapters, like performance management, performance measurement here, This was not part of F2 syllabus before. They have recently added them into F2. This actually they belong to F5. So we will be discussing them in more detail in F5. In F2, it is just an introduction. Okay. So do not expect very long explanation for this thing. And they are mostly theoretical. In your F2, what you are focusing on is costing, like absorption, marginal and process costing, and then budgeting and variances, and of course, material, labor, etc. Those were the chapters you need to focus more. So comes return on investment, which is also called ROI. You can calculate it with two formulas. It is also called return on capital employed, return on capital employed, return on capital employed, which is called ROCE. You call it ROCE. The formula of ROCE is profit before interest and taxes, PBIT. This PBIT, sometimes it is also called EBIT, earnings before interest and taxes, divided with capital employed. And what is capital employed? Capital employed means total assets minus total liabilities. Capital employed is total assets minus total liabilities. So this is the formula. For example, and I'm telling you, it is not net profit, by the way. This is called profit before interest and taxes, like the profit which you made before interest and taxes. And I'm not sure if you have seen the format or not. Let me tell you how does it look like. Okay, I'll just make a very quick thing. So you write down your sales, probably $100. Then you write down your cost. Your cost, maybe, which you call cost of sales, maybe is $40. So it gives you your gross profit. Okay, your gross profit, which is $60. Then you have your admin expenses, probably $10. Then you have your distribution expenses, maybe, okay, let me put it in bracket. So this is $10. Then you have your distribution expenses also coming in negative, like, I don't know, $15. Then you have your other expenses, which are, say, I don't know, $10. So, or $5. So what you get now? So what you get now, let me just format that. And then you have, oh, gross profit is like 60. Okay. Then you have your admin expenses, and you have your distribution expenses, you have your other expenses, and here you get PBIT, profit before interest and taxes. So we have to subtract $30 is your PBIT, which means before taxes and before you pay your interest, your profit is 30. Then you pay your interest expense. If you have any interest expense, let's suppose it is $5, you pay interest 5, and here you call it profit before tax. Okay, profit before tax. Profit before tax. And that profit before tax probably is 25. Then you say your tax expense, and let's suppose that your tax expense is, I don't know, $5, and then you say profit after tax. Now this profit after tax is called your pure profit. Okay, this profit after tax is your pure profit. What we are talking about here is PBIT, this line, which means the profit which is before interest and taxes. Of course, this is not pure profit, but it is also called operating profit. And you should remember that most of the financial performance management measurement is done at this level. You, in all of the ratios which you may use in F2 or which you may use in F3, you are always taking this profit. You never measure performance on this profit. Why you do not measure on this profit? Actually, this is the real profit, but we do not measure here. Why? That I will speak sometime late. Now it is not the time. What you need to remember, that whenever you are doing any kind of measurement, you are doing PBIT. Okay, this PBIT, it is something which you discuss more in your financial accounting. But because we are doing fund management accounting, so a little bit was needed. So I explained. I did not want, I don't want to go into more detail to confuse you, because it is not something very much focused in your syllabus. So what you should understand, that PBIT is here, which means before interest and before taxes. This is not pure profit, but we use this number, this line, very important for all of our performance measurement levels. Whenever you are calculating ratios in F3, in F7, or anywhere, you will always use this line, okay? This is what you need to remember. And it is also called operating profit. It is also called profit from operations. Anyways, our ROCE, which is one of the most important, if you ask me, it is one, it may not be accurate. It has many problems. It has some disadvantages, but even though it has disadvantages, still ROCE is very popular with investors. They want to check what is the ROC of any business. Last year, your ROC is 12%. This year, your ROC has improved to 13%. Your investors will be happy. But if you show ROCE 11%, they may not be happy. So you must control ROCE. This is one of the measures. And you may use another formula, which is called ROI, another formula that is called ROI using controllable profit. Now that's a different thing, controllable profit. Sometime it is also used. So you say controllable profit divided by controllable investment. So I'm not saying PBIT, I'm saying controllable profit, which are also called traceable profit. Now, what does that mean, controllable profit? Let me give you an example. Let's suppose that you have a bank which has a head office, okay? This is your head office of the bank. And then there are different branches, branch 1, branch 2, branch 3, etc. And you give them target on profit, okay? So you tell each of your branch that you must, so what happens? Head office makes some investment. Head office invest $1 million. They give them $1 million of investment. Go and start giving loans to people and start collecting some interest, and you give us some profit end of the year. So we invest in each branch. We have got investment in each branch, and then branch makes some profits, and then we say, okay, let's divide branch profit with the branch investment, how much investment we made. And we say, okay, you made a profit of 10,000 and your investment was 100,000. So your profit is say 10%, and we are not very happy with that. This is very low. Maybe it is the scenario. You know what will happen? Now comes the controllable issue. The branch manager will say that my profit actually should be more. Because what is happening, if you go into detail, head office is doing advertisement expense, okay? Head office, these branches individually do not advertise. Any advertisement which you see on television or any media, branches are not doing it individually, you know. Head office is doing. So what head office is doing, head office is spending some money, probably $500,000 head office spent on advertisement. And then what head office will do, that head office will take this $500,000 profit and it will divide it to different branches. You remember? You did a lot of absorption, marginal costing, or cost allocation. So head office will spend 500,000 and give 50,000 to this branch, 50K to this branch, probably 60K to this branch for on some method. Using some method, they will allocate all of this profit, this cost to different branches. Now, the branch manager will come in and say, you know what, this 50,000, which you are writing down in my income statement as my expense, I never spent this money. This was not my decision. This was the decision of the head office. I actually never needed this advertisement. I'm doing my job fine. I'm using direct marketing. I go to my customers' offices door to door. I knock to them. I bring in my corporate clients by visiting their office. You give advertisement on TV, which I don't want, and you charge me 50,000. And you write down this 50,000 in my income statement as my expense, which actually I did not decide. Remember, whenever you are doing measurement, you are checking the manager's performance, okay? You are making manager as responsible, and manager becomes responsible for his profit, but he says that I am not responsible for this 50,000. I did not spend it. So therefore, if you ignore this 50,000 in my income statement, my profit actually was more. Probably it was 30, 40, 60,000, whatever. My profit was more than that, okay? Because you subtracted, you charged some cost to me, which cost I never agreed. You spent money with your own choice, and then you deduct it, you charge it to my expenses. So you say controllable profit. Controllable profit means that we only consider those expenses and profits or revenues which are controlled by the manager. So we should ignore this thing. In controllable in controllable ROI, in controllable thing, you should ignore those costs which were not decided by the manager. He said this is not in my control. Okay, so let's talk about only, because one very important thing you should remember. Please pay attention to this. This is the fundamental principle for performance measurement. Fundamental principle. People should be held responsible for only those things which are within their control. You know, when you're measuring someone's performance, people, they get demotivated. If I start blaming you for something which was not in your control, you will be demotivated, because I will be demotivated. They call me in and they said, you only made 10%. I said, you spent this money. This was not in my control. So you can only ask me those things for which I have authority. You can only ask me those things which are within my control. That is the fundamental principle of performance measurement. Managers should be held responsible for the activities which are within their control. If I'm not controlling something, I should not be held responsible for that. A very simple thing. It applies in our daily life. It applies in your real life. I mean, you live in a family, you have some responsibilities towards family. Somebody asks you, somebody check your performance, how good or bad are you doing? And you should only be held responsible for those things. I mean, if I made a mistake, I'm responsible. But if my brother made a mistake, why should I be held responsible for my brother's mistake? So if you start putting blame on me for my brother's mistake, I'm unhappy. I do not agree to that. The same applies in the business. I'm calling a manager and I'm making him responsible. I should be only asking him those questions which are within his control. So therefore, this is another method of measuring ROI in which we talk about controllable profits and controllable investment. Anything which was within his control. Now, let's suppose that I ask my head office, give me 100,000, okay? Give me 100K. I will work with 100K. And they sent me 150K they gave me. And then they start saying that, you know, you made $10,000 on 150K. So you made only 7%. I say, listen, I only wanted 100K. I was planning to make 10,000 on 100 so that it should be 10%. You are making more investment. So this investment was not in my control. I am not responsible for that. My control was this one. Similarly, the profits and the investment both. I hope that you understand this issue of controllable thing, controllable. It's very important. Residual income, this is another approach, RI. Now you should remember that this ROI and this ROCE, these both, they come in, you know, percentage. They both come in percentage. So when you calculate some numbers in percentages, it has some advantages. It has some advantages. Why? Because if you remember before, I told you that you made profit from $100 sales, your profit was 20, and your profit percentage was 20%. Okay. But in next year, your sales were 130, your profit was 22. So apparently it looks like that you made more revenue, very good. You made more profit, very good. But when you calculate percentage, it makes 19%. Now it looks bad. So percentages are good because sometimes percentages are easy to compare. Okay, when you see things in percentages, they become more clear, because here you might be think that, oh, I made more profit, I'm happy. But then when you see 19%, you say, oh, I made less, my profit percentage has gone down. So percentages are good, but there is a big but. Sometimes percentages are bad. Percentages, they do not tell you a lot. Why they do not tell you? For example, one manager, I give 100,000, I give 100K to one manager, and he gives me, 10% return. I'm happy with him. This is my manager A. Another manager, we gave 1 million. We gave 1 million, okay? And he makes 9%. So it looks like if we only compare the percentages, it looks like that he is giving less. But if you consider the dollar value, he is only earning $10,000 for the company. If you talk about the bank balance now, he is adding only 10,000 to the bank, but he is adding 90,000 to the bank. So although he is making 9%, but he is making 9% of a very big investment. He is making 9% of a very challenging project. He is making 9% of a very difficult investment. So if I see percentages, this looks good. But if I'm interested in real dollars, this is doing good. So it means that this percentage thing, sometime it can, misleading. It can provide misleading result, or it could create some confusion. Because you should remember that it is very natural that large projects, they give lower percentage return. It is very common. Small investment gives a lot of profit, by the way. For example, if you sell fruits, I tell you, if you sell fruits, you know what will happen? You will go to the market, you buy fruit for $50, and end of the day, you will sell your fruit for $75. So you are actually making 25%. That's great. On fruits, you make 25%. But if you purchase a car for $20,000, you cannot expect the car $20,000 with 25% profit and selling it something like 25. It is not possible. Probably it is not possible. Maybe selling a car will give you only 10% profit. When the size of the investment goes up, it is very common that profit percentages, they go down. So therefore, this ROCE and ROI, they calculate your profitability in terms of percentage, and sometimes percentages we do not need. We also need the dollar value. We just don't want to see what percentage we are making. We also want to see how many dollars are we making, okay? So that is called calculating it in dollars thing. So how to calculate that? For this purpose, you have got RI, which is called residual income. Now, residual income, it talks about controllable profit minus imputed interest charge on controllable investment. So again, we talk about controllable profit, and I'm sure that you know what do we mean by controllable profit. And then you say imputed interest charge on controllable investment. What is imputed interest? Interest, interest is an expense which you pay on some loan or debt. Imputed means that it has not been given. It has not been given. It is something which is supposed. You can say that supposed interest. What does that mean? See, this is head office, and head office has given $100,000 to one manager. And the manager, he makes a profit of 12,000 on that. He makes a profit 12,000, and the manager comes in end of the year and say that, see, I made a 12% profit. You gave me 100,000 investment. You gave me investment 100,000. On this investment, I make a profit of 12,000. So I am giving you 12% profit. You must be happy with me. You know what head office will tell them? Head office will tell them that, see, we gave you 100,000. If we have given this 100,000 to a bank, if we had put this money in a bank, we would have got 10% from the bank. So 10,000 we would have earned even without your efforts, okay? So 10,000 I would have earned in any case. Even if I put my money in the bank would have given me 10,000, which is 10%. So you are actually not giving me 12,000, you are just giving me 2,000. Because imputed interest means the interest on that investment, the cost of capital you call it, okay? The interest rate which you otherwise have earned from that. I'm sure that you understand my point, that I'm giving you 100,000, you bring me back 12,000 and you say, oh, sir, I'm making $12,000 profit for you. Listen, you are not making 12,000 profit for me. You are only making 2,000 profit for me, because 10,000 I was already earning in the bank. The money was in the bank. I was making 10,000. I took money out from the bank and I gave it to you. So this is, I'm losing 10,000 from here, okay? So when you give me 12,000, I only see it as 2,000, because 10,000 I started losing from here. This is not coming to me anymore. What you are adding is only 2,000. So this is called residual income. Residual income means that the profit minus the interest cost. Okay, so, and it is expressed in terms of dollars. Advantages of ROI and RI. So we have two methods, ROI, which tells us in terms of percentages, and RI, residual income, which expresses in terms of dollar value. So ROI is a relative measure. Relative measure. Relative means that it is percentage. It is not absolute. It is not in dollars. That's why you call it relative. It's a relative measures, where RI is an absolute measure. Absolute means that it is in dollar, okay? Relative means that it is in percentage. Consequently, RI has an absolute measure of performance, is used to select proposal based on the absolute increase in profit. Absolute increase in profit in terms of dollars. This can be demonstrated in the example above. I explained you already that I actually have given you the example of this percentage, how to do it. So no need to create an example again. Disadvantages of ROI and RI. It can be difficult to identify controllable traceable profit. Yes, sometimes it may be difficult. Sometimes it is very obvious, but sometimes it is difficult to identify controllable profit, because some of the expenses from head office. So head office will say that, see, you are asking me, if you remember that $50,000 of budget for advertisement, and you said that, why did you spend this money? I'm sure that within your customers, maybe there are some customers which came to you because of this advertisement. Now, how do you find out that which customers came through advertisement and which did not? I mean, customers, they walk into your bank. How did they know the bank is there? Or did they just watch this advertisement sign on the road? Or did they watch a television advertisement and came to you? So sometimes it becomes difficult. When organizations value assets at net book value, ROI and RI generally increase as assets get older. Now, this is a little bit tricky thing. I do not very much agree with the ACCA, why they are using this argument in ACCA F2 level, because students have not read F3 and they don't know net book value. But I can explain you this thing still. I'll try to explain you. I mean, I don't agree with the syllabus, this part of the syllabus. So, but I will try to explain you how it works. What does that mean? See here, you've got here your assets, which you will consider your investment. And you have your PBIT. So you know that your ROCE, your ROCE is a percentage, or ROI, like profit divided by investment. You have profits, for example. So if I say here, so I've got here 2010 and I've got here 2011. And in 2010, my profit was $10,000. And 2011, it still is $10,000. Here, my assets are $100,000. And because of $100,000, my ROCE is 10%. It is normal. Now what happens? This assets which I have, now here they use the word book value. If you pay attention, when organizations value assets at net book value means assets, they become old, they depreciate, and their value decreases. This is a concept from Financial Accounting F3. I'm not sure if you people are aware of that or not. Actually, F2 syllabus, we have not discussed it so far. So just you need to remember that this $100,000 asset, when it becomes old, so it was, let's suppose these are 5 cars, 20,000, 20,000, 20,000, 20,000. I use these 5 cars for rent a car. Okay, I have a rent a car company, 5 cars, 2020, 2020, 100,000, and these 5 cars are giving me $10,000 profit. Then when they become old, after 1 year, the value of these 5 cars becomes 80,000, because now these are old cars. They are no more 20,000 each. These cars are probably 16,000 each. 4,000 per car value goes down. So it means that your asset value goes down. And then when you see your ROCE now, 10,000 divided by 80,000, now it comes like 12%. So what happens that I go to my manager, I say, see, last year we made 10% ROCE, this year we made 12% ROE. Hurrah, we are doing good. Our ROCE is improving. Our shareholders will be happy. This is not very true, because you see your profit were the same, just like before you did. It was 10,000 before, it is 10,000 now. Why do you see this ROCE at a higher level? Because you just decrease the value of assets as the assets are becoming old. So all of your activities are same. 5 cars last year, 5 cars this year, 10,000 last year, 10,000 this year, but ROC goes up. ROC goes up because of the value of the asset goes down. So this is one of the biggest disadvantage of ROCE, that sometimes the ROCE looks better because of, not because of you are doing good, but because of the fact that you are using an old asset. And then there is another disadvantage which they have not given on this screen, but because we have started the topic, so I will try to speak on that also. Next year, you again did $10,000, okay? But what happened that end of the year, just in 2000, like just in the December, just last month of the year or November of the year, you purchase some new asset. You purchase 2 new cars. And when you purchase 2 new cars, like 20,000, 20,000, your investment becomes more. And now what will happen, that it will look like 7%. Now that's a surprise. Why this is now, generally what happens, you should remember that whenever you purchase some asset and add it into the business, your profit should increase because asset is working. Asset, so before you had 5 cars, now you have 7 cars, but profit is same. You know why? Because you just purchased them in December, and in 1 month they did not make any profits. They just came into the business. You will be using them next year. So I purchased them in December. So immediately they are added to my balance sheet. Immediately they go into my asset. I say, oh, I've got 7 cars now. But these 7 cars did not work for 12 months. These 7 cars never had an opportunity to make profit throughout the year. You just got them 1 week ago. And this also will bring down. So now everybody will come shouting at you, oh, why your ROC has gone down? You've got under $20,000 of investment. You will say, yes, I got 120, but you just gave me these two new cars on 25th of December. I never had an opportunity to make money. Give me some chance for the next year, and next year I will use these 7 cars for 12 months. Then this 10,000 I will make it 15,000. Okay, so just you have to wait. So these are some disadvantages of ROI and RI. Okay, next I have to clear that. Can you people listen me? Can you listen me? Because I cannot move anything. I cannot press anything. It is not allowing me. My system is stuck.